So today we are talking about the poor man's covered call. So we'll have to talk about covered calls, but then we're going to talk about utilizing options as a leverage tool, as a stock replacement strategy, and then essentially selling covered calls. So the same rules apply. There's just another layer of complexity that we're going to add. Probably keep this one short and sweet today, 30 to 45 minutes, and have some time naturally for questions. All right. So let's get started. And naturally, there are some real prices today, some screenshots. Those are past performance, not indicative of future results. It's for informational and educational purposes only. Options include risk because they're complex. They're not for everyone. So it's important to be educated, which you're taking the time to do today. Just know anything within this video and webinar does not constitute individual legal tax or planning advice. Now that we are all covered, I'll give you a moment to read this so briefly. And there we go. All right, so let's talk about a review of a covered call. We'll talk about building the poor man's covered call and what it looks like. I hate the title poor man, but it's poor man because you're spending less capital is the intent of it. Then we'll compare the strategies side by side. There's always a give me and a gotcha. We talk about that with options quite often. What is that in comparison to just plain vanilla covered calls versus the poor man's covered call? That's important to discuss. So we go through that. We'll talk about some practical application, put it all together, and then of course to save some time for Q&A. So let's break down what a covered call is. Covered call is basically a long-term income orienting strategy that you can add to your portfolio. Could be shorter term, but longer term based on the strike prices or expiration dates really that you are selecting. In order to deploy a covered call, you have to own 100 shares of an optionable stock or ETF. And that's depicted by this dotted line right here. So whenever you own stock, we're talking about a cash account, the most that you can lose is the amount that you spend, right? The capital that you're extending in order to create that investment, whatever that thesis may be. But the most that you can gain is theoretically unlimited because you could hold that stock forever. It doesn't have an expiration date attached to it. It could go bankrupt and things like that. However, there's less complexity because of that reason, but from a risk reward perspective, you are spending a set amount of money with unlimited gain potential. So in order to create a covered call, what we do is utilize the stock that we already have. And since one contract represents 100 shares, we have to own 100 shares of an optionable stock or exchange traded fund. And you sell a call option utilizing those shares as collateral. The reason why I say ETF, you can't do this with index options because you can't own the actual index, but you could do a poor man's covered call with an index option, which we'll talk about. So you sell a call. The gimme is you receive an upfront premium. The gotcha is you are creating an obligation to sell your stock and you're capping your upwards potential. And that's depicted here. So if I'm receiving a premium, I really reduce the overall capital that I'm spending on buying 100 shares of that underlying security. So I reduce my break-even point. And in exchange for that upfront premium, I'm capping my max gain at the strike price that I choose. And the stock, no matter how high it goes, I can't make any more money. And I still have the same substantial risk potential as owning the shares. It's just reduced by the premium that's received. A very common option strategy. But what's really important to consider when you're trading covered calls is oftentimes people will prioritize yield or the premium that they're receiving and not take into account capital appreciation. And there needs to be balance. So that's where it goes into the strike prices that we select. And if you've ever attended the covered call options video that we discuss often, we have that fun little game where we say, okay, you've got a covered call. Which one are you going to choose? Are you going to choose the strike price that's closer to the current stock price, or one that's farther away, or one in between? And oftentimes the one that's selected mostly, at least for the newer users, is the strike price that is closer to the current market price of the underlying security because it has a higher premium. And that's because it's closer to the money. It makes sense. A call contains the right to buy. You're creating an obligation to sell. So if your right to buy is at a higher price, it's going to have less premium, but you have an obligation to sell. So you need to account for capital appreciation. So you could be giving up money if you're only focusing on the yield aspect and not capital appreciation. And that's the important takeaway and something to be cognizant of when you're trading covered calls. So we'll keep that there. Now, if we're building a poor man's covered call, again, really can't stand the name of this one. It acts as a stock replacement strategy. So we can utilize options as leverage. The mechanisms are very, very similar with the poor man's covered call. It's going to actually produce the same profit and loss diagram as we were looking at in the previous slide. The difference here is we are utilizing a right to buy, so a long call, and making it very, very deep in the money. Now, with this example, I have a 0.6 and a 0.7 delta. You can even do 0.8, 0.95, but you want a very, very deep delta or high magnified delta, very deep in the money call. And the reason for that is if you were to go on an options chain and you look at the delta column, or even if you don't, and pull up theta even, no matter how far out you go on expiration, if the option is very, very deep in the money, it loses its extrinsic value component, meaning it's worth mainly, there's still some there, but it's worth mainly its executable value. It has less theta, has less gamma. That's because those are all centered around at the money options. So we're moving away from the at the money options and going to very deep in the money options. And that's how it can act as a leverage and replace the stock. Your exposure isn't dollar for dollar because remember delta, the definition of that is for every dollar that the underlying security moves up or down is what the premium is going to change. The options premium is going to change. So that's why we say the option is acting like the stock with a delta of 1, because if the stock moves up by $1, so does the option. So if you have a delta of 0.7, it's closer, because as the option moves up by $1, this would move up by 70 cents, but it's not fully there. So that's why you would utilize delta as stock replacement, is you want to get that full exposure. And the intent of a covered call is to reduce your cost. And so we're going to think of it almost like a diagonal spread, but we're going to apply it like a covered call, meaning we replace this. It's also going to be a longer dated option. Leaps at minimum are 9 months. So 9 months or greater will be your longer dated options. And remember that delta of 0.85, 0.7, that means it has a lot more traction to the underlying security and less to the extrinsic value component that is going to decay. And that's why you want a deeper in the money option. In order to deploy this, you want something that acts like the stock. And an option that acts like the stock, regardless of expiration, is a very deep in the money one. So that's where that comes from. Now, what's important to consider when we are utilizing a long call to replace as a stock replacement strategy, it also loses liquidity when they go very, very deep in the money. And if you're looking at an options chain, you could see that the bid and ask sometimes get a little wide. There's less volume, there's less open interest, and that's okay. That's why you need to know what it's worth in the intrinsic value component and just understand so you're not fluctuating the bid and ask. But you could use the liquidity raking on the OptionsPlay tool, but also just look out for liquidity when this happens, because it's an event that reduces liquidity. And if you're dealing with a option series or options that just don't have liquidity in general, this is going to be a difficult strategy to deploy. But if you're looking at something that trades quite often, like SPY or Apple or something like that, you should be okay. Now, when we are buying, we want something that has a low IV percentile and your positive vega. What does that mean? Well, it means I'm going to benefit from an increase in implied volatility. So you don't want to deploy this the day before earnings, because it's going to have an implied volatility and that crush is going to happen. So it's just a flag that we want to watch for. So, and the way that we can do that without going through dates is looking at IV percentile. It has a lower IV percentile, lower IV rank. That tells me that implied volatility is reduced, and that's good if we want to buy. You don't want to buy something with an inflated premium that we're utilizing as a stock replacement strategy. Vega is also centered around at the money options, so it shouldn't be too big of a deal, too deep in the money, but it's something that it could be heightened ever so slightly. And that's just not a good scenario. So just a little tip there. And you are still creating an upside bias and you have a net positive delta altogether. Literally speaking Greek sometimes, and there's reason for that. If you're to look at a short call individually, it has a negative delta because it is a bearish strategy individually. So when we sell a call, sell it, say in this example, I've got a short out of the money call at a 0.15, 0.2 delta. So that tells me it's out of the money because 0.5 is at the money. So something further away. So if it's a stock at $100 per share and we're selling at a call at 110, Well, that call is profitable as long as the underlying stays at 110 or moves lower. So it's neutral to bearish. That's why it's neutral to bearish individually. When you add stock, since 100 shares equals 1 delta, and then a very deep in the money, this would have a higher delta, pointing at my screen like you see me. You flip the deltas to positive. And a net delta tells us if we're bullish or bearish. So it's just a fancy way of saying this is a bullish strategy that benefits from an increase in implied volatility on the long option side and decrease on the short side. That's literally it. But we can utilize numbers to tell us the same thing. But it is important here to consider how a covered call is constructed. And we're going to mirror exactly the same thing. That's all a poor man's covered call is. It is utilizing a long, deep in the money option to replace the stock. And then the same rules apply for the short out of the money option. So at OptionsPlay, we talk about 30 to 45 days as the expiration that we choose and a 15 to 20 delta. That way you account for capital appreciation in addition to the yield that you're receiving. And you constantly are going to sell those calls, roll and adjust. And you can even do that with the long leg. Remember, your long leg acts as the stock. So important. That's the way we build it and we set it up. And of course, we're going to build on that. So let's compare strategies. So at first when I joined OptionsPlay, and I'd start putting individual quotes. So a fun little fact, anytime you ever see ABC on here or at 100 strike price, and we do that to keep it evergreen, but it's always based off of Apple and it's normalized to be 100, meaning, and it's rounded, meaning it's always real prices. We always have real prices. Otherwise, what's the point, you know? So, but here it's fun to keep older screenshots with older quotes because you can see what actually happened regardless of time frame. So I find that very useful, at least when teaching. So here we're looking at GIS. Again, this was probably a year ago that this one was put together, but you can pull up the trade, see what happened, where the security is now. But if we're looking at a covered call, same concept. We have the long stock. We own the shares. We purchased it at the last price of around $7.75. We're going to prioritize capital appreciation. So go out about 45 days, sell a 75 call. Well, that probably doesn't have some high implied volatility. We're going to get 60 cents. It's a 0.2 delta. So we're going to reduce our costs by 60 cents. But over time, annualized at a yield, that's pretty high. But we've also accounted for $4.25 of capital appreciation. And again, from a percentage terms, that's great. So our total cost, $7,015 altogether. This is a neutral to bullish strategy, meaning we need the stock only to move by that $4.25. Our max risk is the total amount that we spent, $7,015. And our goal is for GIS to reach 75, no further, to make $485. So basically, we're spending about $7,000 to make $485. Risk versus reward. That's how the OptionsPlay tool is designed, to have you focus on risk versus reward. Therefore, we teach risk versus reward. Moving over to the poor man's covered call, you can see instantly how it's utilized for leverage, and hence where the name comes from. The long call, that's deeper in the money. This one's a 0.75 delta. It is a strike price of 62.5, trading at 980. So a tiny bit of extrinsic value is still in that. The total cost, so we're using the same short call. This one is much longer dated, so about 9 months, using about the 45 days short call, same strike price, so same rules apply. That all is going to cost us altogether $920. So it is a fraction of the price, a little more than 10% that this is going to cost us. And that's why this is deployed often, because a covered call strategy for a long term is capital intensive. If you have a smaller portfolio, but you don't want to be crazy speculative and directional and still want to have that conservative approach and that long-term income approach that covered calls can add, this is a solution. However, we're adding another option, which means we're adding complexity, which means we are adding onto our strategy management process. Anytime you add a layer of complexity, there's a layer of understanding and there's an additional layer of management. That's all, but that's why you're here. So same rules apply. It's a neutral to bullish strategy. Your max risk is still your total cost. And your goal at this case is for it to reach 75 and you'll make 330 because you aren't fully exposed to the stock with a 0.75 delta. You can get a deeper delta. This will be a higher number or wider delta. I like to say wider or magnified. Nonetheless, makes sense so far. Look for some emojis, some smiley faces. Great. Which one are we buying? Which one are we selling? I want to make sure I go through those. All right. Awesome. Okay, we are buying the deeper in the money call, selling the shorter dated, further out of the money call. Okay, so let's do some comparisons. This is about the same thing that I said, but a different format, but it's also some additional info that you need to be aware of. When you have covered calls in your portfolio, you own a stock. When you own a stock, you have partial ownership of a company, no matter how small it is, which means you get voting rights, but you also have dividends that you can collect additional income on, and your stock doesn't expire. You theoretically can hold it forever. Whereas if you just have simply the right to buy via a long call, because remember, long means purchased, call means the right to buy. Since you don't actually own it, you don't have any right to dividends, you don't have any voting rights, you can't participate in any of that. And this type of strategy is going to require margin because you're creating a spread. So there are different requirements from an account perspective. Your sentiment is the same. You're neutral to bullish in either strategy. Your max risk for a covered call is substantial. You still have full stock ownership, but it's reduced by the premium received. Whereas your poor man's covered call, it's substantial, but substantially less because it's the full cost of the long call reduced by the premium received. In both instances, your profit potential is capped at the higher strike price that you choose. So difference of the strikes, less the premium paid for the poor man's covered call. So right to buy, obligation to sell amount, less cost. And then capped for the strike price that you choose on your short call, less. So cost of shares, strike price, less premium received. And we went through the additional information. So important to know, and the main key difference here that we hadn't discussed is those voting rights and dividends. You are not entitled to those dividends. We do have some reports that you can pull in OptionsPlay. This is an older screenshot, so I apologize, but you can actually go into the tool, select covered calls, and you'll see all of this information here to give you ideas. So we can pull up the tool and to go over that. So let me go stop my sharing here, and I'll go over the tool and we'll compare a covered call and a poor man's covered call as well. And Tamar has a very interesting one. In the poor man's call, it's not covered. It's considered covered because it's an offsetting position. So when you do margin requirements on the back end, as long as if you're looking at a spread, as long as, depends on your brokerage firm, to be honest, but the rules are the longer dated option, as long as that is a longer dated than your short option, that will pair as a spread. It's considered covered because it's covered by the long call. A spread's considered covered. All right, let me pull up OptionsPlay. Give me one moment. By an offsetting long position, we would say. And while I'm doing that, if you want to pop your questions in the Q&A tab, and we'll make sure we go over that. All right. Back to Zoom. All right, can everyone see my screen? Yes. Bring the chat back up. Awesome. And yes, you do have to be worried about assignment. You're always worried about assignment if you have a short call, a short option. There's always risk of assignment because you have an obligation, you're the passenger seat. I have NVIDIA pulled up just because that's what I was looking at, but I want to show you how you can find the ideas here. So let's look at a covered call that would be pulled from a screen from OptionsPlay. It's prioritized by yields. So maybe we can build a covered call and, maybe let's do real estate. Toast is an interesting one. If you guys have anything specific you want to do this on, or you want me to select one, let me know. Maybe Celsius. Tesla. Do Tesla. Amazon. Okay. First Solar. There's lots for Tesla. We can do Tesla. I haven't done my charting on Tesla yet, but I have a feeling that it will be bullish. But why not Tesla? Tesla is a difficult one to do this on, high beta stock. So know that you are capping your upwards potential on something that moves a lot. So let's keep that in mind. All right. And I also have not done my full analysis on this, and I plan to. If you follow me on TikTok, you'll probably find it there. All right. So let's look at the way that it would start a covered call. We've got our August 9th, 2024 250 strike. So OptionsPlay is already accounting for the fact that this is a high beta. Let's make sure we have some good capital appreciation. But this is going to give us $270. So $2.70 per share. Our max reward is 5,520 and our max risk is 19,480. But here's the data points I want you to pay attention to. This is about a 43-day time frame. If you were to look at the $2.70, especially with the way that Tesla moves, it's up $1 today, say, oh, that's not really a lot of premium. But from a raw yield perspective, that's 1.39%. This doesn't pay a dividend, and that's definitely a lot less than minimum rates you can get nowadays in a restrictive Fed environment. However, if you were to annualize that, because remember, that's a raw yield over a 43-day period. It's literally taking 270 and dividing it by the last price. If you were to annualize that, 12.4% is beating a lot of yield that you can receive. And that's the beauty that you can utilize with this. But that's why this tool is extremely helpful, because you want to look at it in those terms, especially if you're considering yield on your portfolio. Annualizing it is extremely helpful. And of course, you can adjust from there. Now, if we wanted to modify this and shift this into a poor man's covered call, I'm actually going to do it on this. Let's do that. Let's modify this one. And we will do a very deep in the money. We need to go pretty far out. Let's do maybe November 15, December 20. So here you're going to see the defaults that it just made for a bull call spread. Remember, I said a higher delta. So we're going to look for the higher delta. We're looking at 0.75. Sometimes you do the mental math. I might choose a 180, which is so interesting that that's one standard deviation out. That to me is crazy. But I'll choose that because it is one standard deviation. So that's further. Now we've created at 235, but remember that tool when we did covered call was 250. And that is giving us about 318 because I switched it to the midpoint. And the other one was August 19th. There we go, 270. So here is the same exact strategy, but less capital. And what we can use here is see exactly what happens and compare and contrast. So I've got the buy shares here. I'm going to create this one as a cover call. So just give me one moment while I build that for you. So I'll just flip this to sell. And we've got the August 9th, and we did 250. And let's add stock. And now we have a covered call. Okay. So now we can compare. Is this big enough for everyone to see as well? I can zoom in a little bit. Sure. All right, so now we can compare what actually happens in different scenarios. So what happens if the stock declines? Well, we're actually going to lose less here, and that's because we spent less. And where all the strategies are selected. But our biggest risk is still with the amount that we spent and the trade cost here. And this is percentage-wise is very, very high, meaning the amount that we spent, we can lose very quickly with this because it is the decaying asset that is the option. If it were to remain exactly the same by expiration and around 198, let's make it, I'll type it in, 197.42, we're going to have a slight loss because of the extrinsic value component of the long call that we purchased here. However, this is why I want to show you this. It's a neutral to bullish strategy. You still make some profit because you're going to realize your maximum gain potential on that 250 covered call. I don't know why this one's showing losing ever so slightly. Might be a little hiccup there. Now, if this goes really, really far, and let's say it goes past our strike price, or even right to our strike price. So let's put in 250. We've made the same on the covered call because we have capped gains potential. We made a little less, but percentage-wide, we made a lot more on the poor man's covered call. So hopefully that gives you an idea of a little more risk, but same gain potential that is there. But if it blows through our strike price, you're going to make naturally more on the 100 shares because you haven't capped your gain potential. We make our max gain here and we make our max gain here. So there is less gain potential in comparison when you're building or utilizing the poor man's covered call. However, you're spending less, and we look at it from a risk versus reward perspective. So our total cost versus our max reward, there is a huge difference. And we would assume that we would adjust this going forward as well. So wanted to give you that comparison and show you how you can utilize the OptionsPlay tool. And it is great how it considers high beta because that is still accounting for a $50 move in the underlying security to be profitable. All right, so 444. Doesn't that mean good luck of something of some sort? Let's take some questions. If I can find them, they have disappeared from my screen. And there are 25 on the Q&A. What is delta you choose for the short leg and the long leg? So for the short leg, we chose by default what OptionsPlay had here, and I'll show you how you can look at it because this is designed to give you this optimal starting points. So if we were going to modify, the 250 was a 0.15 delta. And the 160, so this is where I made a decision. I went one standard deviation and went to 0.8, but you could use a 0.75. It's going to have a little bit less of a cost, but I went one standard deviation, which I find is kind of hilarious that that's how far one standard deviation is. So you can use a combination of both, but that's how we have our strike prices set up is you can look at the standard deviations and then you can also look at the delta and then look at the premium. That's what this is. And that's also what these represent. Get that question oftentimes is why aren't they fully shaded red or green? Well, that actually represents a standard deviation. So it's a good visualization of probabilistic perspective of it reaching your strike price. All right. Did that. Can you talk about assignment in your Tesla example? So anytime you have a short option, you are likely to be, not likely, but you can be assigned at any time because you're creating an obligation to sell those shares at the buyer's discretion. So we've got to remember the person who is long an option, the offsetting long position, owns the right to buy those shares at that specified price. You have agreed to sell them to them at that specified price. So they could do that at any time. It's likely when the short option is in the money, there's an ex-dividend date, or in all those scenarios, when your short option isn't pricing any extrinsic value, it's only worth its intrinsic value. If it's only worth its intrinsic value, then the person who is long that offsetting short position, they would make equal money taking ownership of those shares or on the secondary market. Therefore, you are highly likely to be assigned and could be assigned early in that scenario. Normally with covered calls, you're assigned early because of an ex-dividend date. So the day, in order to qualify for a dividend, you need to own the stock the day before the ex-dividend. So that's when you need to check it. When you have a covered call, you take the amount of the dividend plus the extrinsic value component that is in that option, if any, and if it is bidding equal to or less than that, you're going to get assigned. You have a high likelihood of assignment because it would make sense for the person who is long the option to actually take ownership of those shares and qualify for that dividend. And you normally don't know that until the very next day. So the same assignment risks apply that are true for covered calls. There is no assignment risk for your long option because you're the one who controls that assignment. But on the day of expiration, if an option is in the money by 1 penny or more, it's automatically going to be exercised, subsequently assigned. All right. And yes, the recording will be sent out via email, and the slides already sent them to Philip. So thank you for that, Philip. All right. At times, my long call is losing money at the same time my out of the money position is also losing. Why? Well, that could be because it's staying exactly the same, because you have to remember that your long call, if the underlying doesn't move enough, so you may not have a deep enough in the money long call chosen, because it's going to lose its extrinsic value component. So if it's not moving up more than the extrinsic value decay, then you're going to create a losing position. So which tells me it has extrinsic value, so you didn't choose something deep enough, or it's moved against you and it's not very deep because it's moved down. That's one piece of it. If the stock remains the same, all else equal, you're going to lose some extrinsic value. Your short call may have it. This is why earlier I said pay attention to earnings, because if your short call you sold that like really, really far away from earning, and then all of a sudden earnings is there, that could create an inflated premium and that may deflate. So you need to check that, but that could be why, because premiums, you have to understand how they're priced. They're going to go up if executable value increases. They're going to go up if there is an increase in implied volatility, and they're going to go down with daily time decay. So it's a combination of those that could make that occur, but that absolutely is something that's viable. All right. Okay. I have a pretty small screen. I'm doing this one on my laptop, so hopefully we answered that one. At what date, this is a great question, Nick, at what date do you need to be or should be out of this strategy, long expiration date, short expiration date earlier? So we are going to assume that this is acting just like the rules and best practices that we utilize with covered calls. The long option is just a stock replacement strategy. That is it. So you have your very deep in the money, that's 9 months or greater that you're choosing your long strike. Your short strike is sweet spot's 45 days, but could be 30. So 30 to 45 days is your short call. You want to close that about 14 till 21 days of expiration of the short call, because that's when the theta decay occurs. And you want to make sure that you account for that. But that's when gamma risk increases, meaning that you could become unprofitable in those scenarios. So at that time frame is when I would look to assess it. But same rules apply that we teach for covered calls. Corey asks a very interesting question. What is the shortest DTE one would use for the long call leg? Remember, the intent of this is stock replacement. It definitely needs to be equal or greater than your short call, and it needs to have minimal extrinsic value. So as long as it meets those check boxes, you are creating a poor man's covered call. You're utilizing it for leverage. If it's less of a date, then you're exposing yourself to unlimited risk potential of the short call. So it needs to be at minimum that. You could technically put it together, but the intent is to do it longer and then sell continuous calls. Um, covered that, covered that, covered that. Donald has a good question here. Please discuss strategy when the underlying declines value over time. Thank you. Well, when you are deploying the strategy, you are neutral short term, bullish long term. There's a stock involved and there's a stock replacement involved. So if it's going down, your investment thesis and reason why you chose this underlying security is incorrect. And so we have pretty steadfast rules. You lose a certain percentage, then you should exit out of that position and move on to the next one. Because if you don't have conviction that this is a bullish strategy, then you need to cut your losses and move on. That's why we say have the 2% rule within trading. That's very important to be disciplined in that aspect. But we get that question a lot, even with the covered call strategy. What happens if it's moving down? Well, you chose to buy that stock for a reason. Do those reasons still hold fast? Was there something that comes up? Maybe you purchased Nvidia is not one I would do cover calls off of unless there's like a clear resistance zone. But trying to think of a real example, Apple was stuck in a trading range. That was a great time to sell covered calls and do the wheel strategy on essentially. And if it fell and broke its support, I would ask myself when I was deploying that strategy, am I still bullish on Apple? I personally thought they were going to release something AI-wise. WDC happened, and then they certainly did. And then that makes you adjust your strike prices higher and maybe consider, do I actually want to cap my upwards potential? So meaning the same rules in this type of strategy that you take into consideration when you're going long or you're buying the stock, you want to speculate, apply. That investment thesis has to apply. All right. Okay. All right. Well, we went through most of those. Someone said there was a problem with Zoom, then I can't see you. I am assuming that got updated. This is the last day of, or last Thursday of June. So you will not see me again. But I do want to thank you guys so much. I really enjoy these presentations and for everyone showing up. So thank you for that. If there's any other ones you want us to do, please let us know. I will make sure that Tony gets that. And I hope everyone has a really lovely week.